Hello, everyone. Hope all is well. My name is Sebion from Emerj360, and I am here to give the Q2 2024 market update. As a reminder, Emerj360 is a division of TrustPoint, and client portfolios are managed by the TrustPoint investment team. Today, we're going to discuss how markets performed in Q2, some conflicting economic data we're looking at, and how we are currently positioned within client portfolios. I want to start by talking about equity markets. Markets in general performed well in Q2 and have overall year to date, with global stocks up just shy of 12%. But this has been led by a very specific area of the market, and that is US large cap growth. And even more specifically, by individual names that are directly or indirectly involved in the growing landscape of artificial intelligence. So you can see the US large cap growth space is up over 20%, while global stocks year to date are up just shy of 12. So in general, stock markets have performed well, but a very specific area of the market has outperformed the rest. And we showed this chart in Q1, but the same story carried over into Q2. And that is the outperformance of the Magnificent Seven stocks that fall into that US large cap growth space, specifically in the artificial intelligence bucket. So the Magnificent Seven are up 33% year to date, while the rest of the market is up just 5%. So you can see the share of returns that they've had is over 60%, right? Which is a great outperformance. So markets, again, in general have done okay, but it's really been led by a small group of stocks, very narrowly led by the Magnificent Seven. Fixed income market returns have been generally flat year to date. Global bonds and US bonds year to date up 0.13% and down 0.71%. Again, this area of the market will continue to be driven by the Federal Reserve's interest rate policy, and they're going to be looking at economic data specifically around the job market and the inflation data as well. So remember, interest rates and bond prices are inversely related to each other. So when rates go up, bond prices go down, which is what we saw in 2022. But it works on the flip side as well. When rates go down, bond prices move up. So again, fixed income markets are roughly flat year to date, while equity markets have performed well, specifically a small group of individual stocks. Next, I want to talk about the consumer. So the consumer is the most impactful component of the economy. So if we have a good idea how the consumer is performing, we generally have a good understanding of how economies will perform. But the consumer is showing us conflicting data. So we have three different slides that I want to chat about within the consumer, and it's based off three different time periods: past income, current income, and future income. And how the consumer is involved in those time frames. So each chart tells a story that if you looked at this chart, you could take away that the consumer is not doing well. If you looked at this chart, you could say, well, the consumer is actually doing okay. So the first is past income. So the story where the consumer might not be doing as well is excess savings have evaporated, right? So excess savings increased coming out of COVID. It has since gone down. But on the flip side, consumers' balance sheets are strong. So this line chart on the right shows US household net worth to disposable income, right? So even though excess savings have gone down, consumers' investments, retirement accounts, right, their net worth has increased. So again, conflicting message there. Current income, so the chart on the left shows that job openings and hires have declined, right? Which in isolation, you look at that and could, raise some red flags, some warning signs. But on the flip side, wage growth is still high, right? So wages have increased, especially coming out of COVID. So we've seen job openings go down, but we've also seen wage growth kind of maintain its elevated levels. And then finally, future income. So on the left here, the cost of borrowing has risen, right, as interest rates have risen. So the line charts there show credit cards, personal loans, and new car loans, right? But on the flip side, debt servicing costs continue to be contained. And a lot of that has to do with the low fixed interest rates from pre-2022, right? Think about all the folks who locked in different debt at lower interest rates, right? A 30-year mortgage at 3% or 2.5%. So while the cost of borrowing, today has gone up, and that will definitely impact today's consumer and the future consumer, history giving us some context on the other side that the debt servicing continues to be contained just because of the low interest rate environment that we were in for quite some time. So with all that being said, within client portfolios, we continue to maintain a balanced view between stocks and bonds, meaning we're not favoring one asset class over the other relative to our target. So within a balanced objective, we would target 50% stocks and 50% bonds, and that's where we're at today. Within equities, we continue to favor US stocks over international stocks with a tilt towards quality. And then on the fixed income side, we continue to favor quality over credit markets. So no changes were made to client portfolios in Q2. As a reminder, we did make 2 changes in Q1 that got us back to target. We were fairly defensive in 2022 and parts of 2023, but became more constructive on the US economies in general, and the stock markets. So these were the changes that were made just as a review in Q1, but no changes were made in Q2. So with that being said, I want to thank everyone for watching this. I want to thank everyone for your business. If you have any questions about the presentation, the content we covered, or something that you have seen or read within financial media, please reach out to us, and we're here to help and have those conversations and answer any questions that you do have. Hope everybody has a great rest of your summer, and we'll see you at the next market update in October after Q3 has concluded. Thanks, everyone.